Before we dive into the question, Ch'ng Siew, could you share how has the performance of global markets and currencies so far this year?
Thank you, Kim. Good afternoon, ladies and gentlemen. So let me give you an overview of how market is performing. We will start with the global market performance first. As you can see from the chart, Nasdaq was the best performer year to date. It was up year to date about 17% as of end April, and it continued to go up in May. I think as of yesterday, I think it was up 19% year to date. So what about Asia Pac ex Japan index? It also advanced about, not much, but about 1.8% year to date, underperforming developed market, quite significantly, I would say. S&P 500 was up 8.6%. Europe was up about 14.9%, despite recession and inflationary risk in the West. So within Asia Pacific, Korea year to date, Korea, Taiwan, and China were the top performers. Meanwhile, worst performer were Thailand, Malaysia, and India. Sadly, Malaysia is the second worst performer in the region year to date. So let's look at Malaysia's performance. In terms of sector-wise, the Malaysia equity actually experienced a decline of 5.3% year to date as of end April 2023, mainly dragged down by poor sentiment in the banking sector. This is expected because of the banking crisis happened in the US. So it has been a fourth consecutive month of decline for KLCI already. But if you can see from the chart, not all rate, the small cap actually outperformed. Positive return about 3.8%. But the mid cap also doing quite well, gain about 3.9% year to date. So in terms of sector, the top performer were actually utility, energy, property. And the worst performer were actually finance, as expected, industrial, plantation, and also tech. So let's look at the currency. The dollar index actually down 1.8% year to date. But it actually pairs some gain away from the last year's gain. Regional currency this year traded a bit mixed. The top performer were actually Indonesia rupiah, British pound, and also Thai baht. Worst performer were actually Korean won, and also Japanese yen. And last year, Japanese down about 13.8%. It continued to go down, depreciate another 3.8%. And euro also continued its downward momentum. Last year was down about 6.2%, 6.4%, I think. This year continued to drift further lower at about 2.8%. What about China yuan, right? Probably some will expect China yuan to perform very well this year. But year to date, it has been trading quite flat. It was down modestly by about 0.3%, but it's good compared to the last year's down was about like almost 9%. So what about local front? Malaysia ringgit weakened by about 1.3% against US dollar. Last year was down about 5.8%. So it continued its downward momentum. So look, let's move on and look at Malaysia ringgit's performance against the regional peer this year. Last year, besides US dollar, ringgit has actually outperformed most of the peers in the region except Singapore dollar and also Thai baht. But year to date, ringgit Malaysia continued to appreciate against Korean won and also Japanese yen, but depreciated against most of the currency in the region. So it reversed its outperformance in 2022, sad to say that. But economists actually estimate Malaysia ringgit is actually undervalued by how many percent? Around 18%. If that is true, that will attract more inflows, more foreign investment in both like equity and also bond market. Foreign investor, they tend to invest in countries where the currency are relatively undervalued.
We see there have been a lot of movements in the market this year. Malaysia remains unloved by investors. So considering the recent global central bank rate hikes and inflation, what's the outlook for the rest of the year?
Tough question. you'll see from the picture, right? Fed has a lot to do, a lot to tackle. Besides the inflation, which is stickier than expected, now they have to handle the financial stability. Lately, there are a few banks collapsed, right? Just 3 banks collapsed within 2 months' time. So the collapse has actually caused the recession fear again, right? Whether it is something that we should look into that, or is it serious enough to cause the systemic risk, therefore global severe recession? Now we can look at the bank failure. Let's look at what is it in the past. Maybe we can see something in the past to assess what is the situation right now. Yeah. As you see from the chart, it shows that since 2003 and also until 2023, that is the number of bank failures in the past. So US bank failure is not something new. Interesting, right? To observe that during GFC, initially it was about 3 banks collapsed in 2007, and then followed by another 24 banks with total asset about 526 billion fell in 2008. So you know what? There were total 157 banks with total asset of 170 billion collapse in 2010. If I remember correctly, the equity market back then was quite steady. Yeah. So year to date in 2023, there are already 3 banks collapsed, as we mentioned just now, with actually higher than the GFC, level in terms of total asset at about 548 billion. Yeah. So what is the concept? Can you imagine how big is 548 billion? It is actually 1.5 times of 2021 Malaysian GDP. So the banking crisis in the US, is it something that we have to worry about? Definitely. We have to monitor the spillover effect. And there could be, more banks to fail if, let's say, based on the history, right? It is just another, we call that consolidation. Yeah. So the banking crisis in the US, there is a policy in the US, big bank cannot acquire smaller bank. Yeah. But when the smaller bank got into trouble and failed, then the FDIC, will accept the highest bid from the bigger bank to rescue the smaller one. So in the past, there were about 14,000 banks. Yeah, now there are only 4,000 banks. So consolidation is something I think is a good thing for the US. I think, and that could be something that they want it to happen. Too many banks, right?
Yeah.
So the bigger banks, take over the smaller bank. After the consolidation system, the financial system is getting stronger and stronger post consolidation.
Yeah.
So this is something that we observed. Yeah. So let's see the interest rate. Probably you want to ask me another. What is the outlook, right?
Yeah.
So as we see just now, inflation is one of the key objectives that the Fed want to tackle. Now with the banking crisis, so they have to handle it. See, it is very crucial, what Fed is going to do next. But having said that, we think, right, interest rate is expected. We expect that to stay elevated for longer.
Yeah.
So we don't believe that you will cut rates straight away, because the inflation is still pretty high, right?
Yeah.
Although inflation has eased to 4.9%, but it's still far away from the 2% target inflation, right? And the lately released US Michigan 5-year inflation expectation hit 12-year high.
Yeah.
So this is much higher than the previous forecast, about 2.9%. So it is stickier than expected. Yeah. However, we think the banking crisis could help Fed to accomplish the objective earlier than expected. This is something, bad news. I'm sure that you think you have heard about that.
Yeah.
Bad news is good news. Yeah. So we think that this banking crisis will try to and will help the Fed to do the job, right? So recently announced, the US index of consumer sentiment is actually at 57%. So it's actually down. So it's a change of about -9% from last month and about down 1.2% from a year ago. Yeah. US Consumer Confidence Index is actually a leading indicator. Yeah, it fell in April, and it compared to March. Yeah, so we see actually divergence in present situation index and also the expectation index. The actual situation, as shown in the data release, is something that against what the consumer think, right? So the consumer become more and more pessimistic about short-term business outlook. The assessment is like, the market the labor outlook is also less positive now. So it's like, probably the recent data hasn't reflected yet, and it is expected to come down, and the market has pricing. So we are in the camp that we think that definitely the interest rate hike cycle is at the tail end already. Yeah. Whether it will come off soon or not, that will also very data dependent. But we do not see, the interest rate to go lower significantly in a very speedy way. But there is only one direction, which is going south.
Yeah. So I think Ch'ng Siew pointed out the right point that Fed is having a big dilemma between fighting inflation as well as to manage the bank stability. But it seems that the interest futures market now is starting to pricing in rate cut. Do you think, is there any possibility of rate cut by end of this year?
As I mentioned just now, we don't think it will go lower, but we are not sure about the timing. We have to see the market. Market is very dynamic. Unless you say overnight, suddenly, all the market, all the economic data turns upside down, then probably yes. But if we look at the consensus view, there is actually more than 85% probability that the next FOMC will be no hike. Yeah. But if you ask me whether they will cut rate by year end or not, the answer is less likely. And if you look at the chart here, the table here, the probability is actually less than 50. Yeah, less than 50. So we think that the rate is peaked already, and that could also explain why Nasdaq's outperforming year to date.
Yeah. Okay. So we spoke about US. Considering the current trend of economic recovery, should we actually focus on investing in Asia instead of developed economies, which may experience slow growth or even recession?
The slide here tells you the answer. So in terms of the global economy, IMF, even though it has factored in the potential global recession, it's still shown some growth. Although modest. From 2.8 to 3%, but the advanced economy is only about 1 percentage each kind of growth. So we think that the developing economy will offer better investment opportunities. In terms of growth, is about 3.9 in 2023 and then 4.2 in 2024. Therefore, let's zoom in the Asia, right? Why we think Asia is a good opportunity investment. It offers better opportunity, right? According to the IMF, right, the growth in 2023 will be predominantly driven by India and China. So look at the chart here, the pie chart there, right? China and India alone already contribute around 67% to the global growth in 2023. And in April itself, IMF actually projected growth of Asia Pac to be 4.6%. That is the revised upwards, the forecast last October, about 0.3%. Why? Because China growth from the reopening is actually better than expected. So meanwhile, IMF also revised China's growth about, by about 0.8% to 5.2%. So it's all backed by, the recovery in the private consumption. So look at, what happened in the Labor Day, right? Look at the crowd here. You see people everywhere, right? Beijing.
A lot of.
So I can't imagine how are we going to walk in that kind of situation.
Very, very crowded.
Correct. So you look at Beijing, you look at Shanghai, you look at Chongqing, and even Camel. This is an interesting slide, right?
Wow.
Camel is queuing up, all that. So I think okay, that is only photos, right? Let's look at number. So if you look at this graph, tourist traffic is actually up 274 million, up 71% year on year, right? And it's actually up 19% on the pre-COVID level versus 2019. So 274 million is like what? How many Malaysia? Almost 10 times of Malaysia population, right? So the tourist receipt also, above expectation. But then, some will actually point out, say, hey, actually, the recovery is not so good because the spending per capita is coming off.
Yeah.
And it's only like 72% of the 2019 level.
Yeah.
Well, don't forget, China just opened on the 8th of January 2023, right? And in such a short period, with that kind of, spike in the tourist traffic means that the confidence level has come back, spending is coming back, but it will need time.
Yeah.
And this actually, I'm happy to see this kind of chart because that means there is potential to grow, right? It's not there yet, and therefore market is expected to go up as well to reflect, if there is any recovery going forward. Yeah. So I think that would be a good chart for to show that the recovery from China is actually on the way.
Yeah, it seems that Asia and China will be the bright spot this year.
Yeah.
But what about Malaysia? How do you view our current economic conditions and how does it affect our market?
I will actually summarize 4 key drivers for Malaysian market. First one, strong economic fundamentals. I will zoom in later, why we think that the economic fundamentals is actually good, positive, and encouraging. We think there is limited downside now, from the foreign selling's perspective, after, consecutive 4 months of selling down, year to date. And we think that the politics uncertainties is fading, right? We have the unity government. Compared to before the election, we don't know who is going to drive the country, who will be in the position. Now everything is clear. But of course you will say, there's still risk from the state election, all that, right? But things are no longer, it's like, it's never smooth in the past, right? Things, if we've got a good leaders, then issue will be resolved.
Yeah.
The fourth one will be accommodative monetary policy. Yeah. If you look at the economic data, consensus is looking at about, for Malaysia, GDP growth is about 4% in 2024 and 4.5% in 4% in 2023 and 4.5% in 2024. And first quarter 2023, the GDP grew by about 5.6%, above the consensus, above expectation, mainly driven by the domestic demand. So that also shows that the market is quite upbeat, and is supported by the private consumption, and we think that the private consumption will continue to grow. IMF has actually revised lower, the global GDP forecast from 2.9 to 2.8 for 2023, but IMF had actually projected Malaysia's GDP growth to increase by 4.5, for 2023, much higher than the street is expecting. So this is because we think that they also think that the growth prospect remain bright, and is supported by the firm domestic consumption, and also the labor market is quite stable. So inflation is also expected to moderate, and we should see continued decline. And ringgit, as you see just now, right, it is actually undervalued. So the moment it come out, strengthen against US dollar, I think that is where we can see some recovery in the market as well. Now, then foreign shareholdings, right? Then we always ask one question: how much lower that it can go, drift lower? It drifted lower and lower. But if you see, for the past how many years, I think it's about 28 level, and it's already at the historical low. Although recent, foreign continue to sell, but the quantum is much lesser already. So we do not expect, that will be a gap down kind of reaction from the foreign selling. Then the political landscape. As you see, Anwar's, under Anwar's administration, I think the satisfaction is there lah. From the survey, you can see, it's actually 68% actually satisfied with him to be in the driver's seat, right? In terms of occupation, household income, all that. So I think it's better. Maybe we are not at the best situation right now, but definitely we are better than before. Yeah. So then the last one I would say is the accommodative monetary policy, right? If you look at the blue line here, this is from Malaysia OPR. I think I would say, I want to compliment our Bank Negara. Actually, has done a very good job. Compared to Fed, this is not the trend that we want to see in Malaysia. It will kill a lot of SME. That kind of steep, unexpected kind of rise in rates, it will kill off a lot of people. So we would rather to have this kind of flat line, modest adjustment. Therefore, we think that there will be no financial liquidity issue in Malaysia, and the business is not affected. So I think that is why I'm still bullish in Malaysia, especially with this kind of market and valuation.
So looking at the economic numbers as well as the foreign shareholding is now at historical low. I also think that Malaysia fundamentals remain very, very encouraging. So zooming into sectors, I think a lot of investors may be very, very interested to know whether tech is still relevant.
You ask me, my answer very straightforward, yes. It is a multi-year growth kind of investment thesis, right? Yes, in the past 2 years, it has been quite struggling. There were actually headwinds hitting, especially the smartphone market, because of the supply chain issue, the logistic disruption, and then the lockdown and the shortages, all these things, right? And also because of lockdown, during the pandemic, people tend to overspend on the gadget, right? And now cause the excess inventory, and we need time to digest. And it has been 2 years already, right? So we think that based on, recently SEMI actually released, the IC inventory and versus the Fed utilization. It's actually the data actually show that, probably worst has over, and the recovery is expected to be happening in second half 2023. So we remain positive on the global smartphone market recovery, mainly due to the easing supply chain issue, new rounds of high-end phone. If you are the iPhone fans, right, you know that it's going to launch. And then the recovery of China's smartphone market due to improving China economic outlook, and also we like upgrades, right? In terms of camera, megapixel, the foldable phone, all that. So we see a lot of new model in the pipeline. So that will also support, the component player and also tech as a whole. Having said that, besides the weakness that we see in smartphone, some gadget, PC has been weak, but AI, very familiar with ChatGPT, all that, the supercomputing cloud.
It's emerging now.
So it is a multi-year growth story. Therefore, with the recoveries on the way, but then the question we'll ask is, why are we lacking US tech, right? NASDAQ up 17%. FBN tech actually down 70%. 7%, right? So underperformed by double digit, 24%. So the question is whether NASDAQ is wrong, or we know tech better than the US people or NASDAQ, or are we missing out something, right? Or they see something that we don't. So I think it has been pricing, and probably that they are leading, right? So back to fundamentals of tech, we think that, as we mentioned, it will be staying here for multi-years. Therefore, since the industry has already corrected almost 2 years, and it's also at the time, the excess inventory digestion is probably at the tail end already. and China has reopened,
Yeah.
we should reposition in tech and also accumulate on weakness.
And I see the valuation here
Mm.
is very, very cheap. KL Tech is trading at one standard deviation below the mean.
Yeah. So if you see, right, there's another chart I want to show you. There's another team because of the US-China tension, the plant relocation, all that. If you see, this is the US import value, right, in 2023 year to date, yeah, it actually grew 13.1%, right? And who benefit in Asia? If you look at this, India up about 3,790%, right, year on year. Then the other beneficiary will be like Thailand, Vietnam, and South Korea. Of course, China here is negative. It's expected because of the tension ongoing. Then maybe you will ask, hey, how come Malaysia, down 32%? And that also reflect in the recent earnings results, which has shown very weak earnings and also revenue growth, right? To me, if you ask me, I think this is not to say that Malaysia is not benefiting from that. It's just the timing. If you keep track the news, right? Actually, Tengku Zaiful has actually mentioned that the FDI in 2023 were up about from 100 billion to 160 billion, right? And this FDI will need time to materialize and translate into the export value or into the company's revenue and earnings. So, and if you go to Batu Kawan, you will see it's so different from 3 years back. I was like, where am I now? At last visit in Penang, it has changed a lot. Batu Kawan, the tech ecosystem is very impressive. Very impressive. And I went to the site of Intel, it's still under construction. Huge plant. I would
Expansion.
the expansion is like, after this Intel plant has been constructed, commissioned, that kind of employment offers, that will also boost up, the role of Penang and even Malaysia in the global supply chain. So that will happen. And also Amazon also committed, about 6 billion over the next 14 years. Tesla is coming, right? I'm not sure whether you are buying Tesla EV or not. But all these are good news, and Malaysia will benefit from the relocation, and we see the momentum actually quite strong, especially the EMS guy in Penang.
It's coming now.
It is. It's happening.
Okay, so we spoke about how positive we are to Malaysia as well as the tech sector, but the burning question is that whether it's time to buy Malaysia now. Is it time to position in Malaysia?
I think the worst is probably over. And if you look at this chart, right, the Malaysia financial market have underperformed our peers, Southeast Asia, since 2005. So we have been dogs, and it never come out because of we dragged by political issues, this and that. And now we have stabilized a fair bit. Things are changing. We are moving better to a better situation right now. And I always believe mean reversion, right? So the ringgit is undervalued. The market also undervalued. The situation is getting better. Therefore, I would think that it's a good timing right now. So let's look at the P, the valuation. From this chart, we compare with the peers. Malaysia is 13 times. It's not the cheapest. The cheapest is Hong Kong and China, Singapore and China, right? But we are not the most expensive. I think Nasdaq is quite expensive, right? About 26. Why we think that the Nasdaq at this level is quite expensive? Maybe the earnings has not come in yet. Once they recover, probably it will bring down the PE, right? But based on what we have here, the implied earnings yield for Nasdaq is about 3.8%, meaning to say your business is only earning 3.8%, versus your the government bond is like, 3 months is at
Yeah.
5.3%, right?
Yeah.
How to do
Yeah.
business with
Yeah.
5.3%
Yeah.
borrowing cost,
The
right?
disparities. Yeah.
Correct.
Mm.
And Malaysia, if we base on the 13, the implied earnings yield is 7.6%.
Yeah.
Decent, right? For
Yeah.
a company to return, to make money,
Yeah.
and the yield, the 3-month bond yield is only like 2.9%.
Yeah.
So we are in a much better environment right now.
Mhm.
And of course, the next one is China. China implied earnings yield is about 8.5%, right?
Mm.
And their 3-month yield is 1.9%.
Even
So
lower.
they can make money,
Yeah.
right?
Yeah.
That kind with that kind of environment, the rate is supportive and the business growth prospects there.
Yeah.
People are making money, right? So I would think based on this valuation chart, the implied earnings prospect, it is time to buy Malaysia and even Hong Kong, China within. Therefore, we think Asia will benefit as well.
Thank you, Ch'ng Siew, for your insightful sharing. And it appears that the focus of this year will revolve around China, Asia, and Malaysia. And although there are areas of opportunities in the market, it's essential to stay watchful and monitor for any potential market volatility. Phillip Capital Malaysia is an integrated Asian financial house with a global reach, serving you since 1975. We operate in the financial hubs of 15 countries, including offices in Malaysia. We offer a wide range of financial services, including discretionary private managed accounts, unit trusts, money market, stockbroking, futures, and contract for difference, available for retail investors, high net worth individuals, corporations, and institutions. And the financial services that we offer are managed by a team of dedicated investment professionals. Finally, we are your one-stop investment solutions provider platform for more than 400 unit trust funds and more than 76 PRS funds. Okay. If we look at the managed accounts that we provide, we have a wide range of private managed accounts that could cater into different investors' needs. Blue chip could be suitable for value investors. For yield seekers, dividend enhanced could be an option for you. If we look at ESG matters, it have become more important for both corporations and investors in the recent years. And our ESG mandates are suitable for investors who like to optimize the risk-adjusted return and to build a portfolio of sustainable ESG companies. We also have ETF, opportunity, UT, and other products that could cater to different investment preference and financial goals. For global mandates, we have Phillip Global Wrap Account, PGWA, which allows individuals to invest into international stocks, foreign unit trusts, ETFs, and alternative investments. Investors are allowed to gain access to lot markets by opening a PGWA account with us. Our unit trust arm, Phillip Mutual Berhad, offers a comprehensive list of local and global unit trust funds that may suit your investment preferences and financial goals. Phillip Dana Aman is our local Sharia equities fund. We also have other conventional equities offerings like Pearl, Recovery, and Phillip Master Equity Growth Fund. For defensive investors, our money market funds and Phillip Dana Murni, a fixed income fund, could be an option for you. Meanwhile, Phillip Select Balance is a mixed asset fund that invests into equities and fixed income securities. And last but not least, we have a selection of unit trust offerings with global and Asia exposure, including Phillip Global Star, Focus China, and Asia Pac Income. We are now available to answer the questions that you may have, and please feel free to type your questions in the chat box. Okay, we have a question from the floor. Since we spoke about tech, right? What about other sectors like the banking sectors?
Look
Is
at
it
the
time to
laggards. Look at the laggards, right?
Yeah.
So far, the industry has been not doing well.
Yeah.
The tech is not doing well.
Yeah.
And also finance is not doing well.
Yeah.
So if you ask me, besides tech, I would suggest, maybe finance is another sector that we should look at.
Yeah.
Because we think that the landscape is far better right now,
Yeah.
and we are not like US, the
Yeah.
collapse issue
Yeah.
will not happen here.
Yeah, I think even Malaysia banks, they are offering quite attractive dividend yield to investors, right?
Yes.
Okay. We also have another question from the floor. We spoke about tech and banking. What about reopening place like consumer stocks? Is there any opportunity that we can look at?
The consumption, as what happened in the region as well, consumption recovery, once reopen, consumption is the one that will sped up first, right? And I think the consumption recovery has already played out, and it also already reflected in the price.
Please feel free to type your question in the chat box. Okay, we have a question from the participant. What is your view on Asia Pacific ex-Japan sector? It has been lagging since 2018.
Sector?
Yeah.
Which sector? Maybe your question will be Asia Pac ex-Japan market, the performance, right? It says Jack, is it a region?
Yep.
Okay, all right. So it's the region, right?
Yeah.
So I think Asia Pac has been underperformed, right, because of the lockdown in China. So remember there was one time, right? Even some broker called uninvestable in China.
Yeah.
And that happened, the bottom was actually at October 2022, right? So after that, it rebounded. Once that, everybody called sell and even go for zero weight in China.
Yeah.
When China announced that it's going to open up, right, and it spiked up, and the run up is actually continued for months, right? Then recently it corrected again, right? Why is it so? I think it got to do with the global recession fears and also the tension. If you ask me, I think that now is the best time to buy for Asia Pac, especially China.
Yep. And we have a follow-up questions from the floor. Based on the low valuation, we spoke about Asia Pacific and Japan, but zooming into China, Hong Kong, and Singapore, would you still suggest investors to position on these countries?
My answer very straightforward, yes.
Yeah. I think we also show the valuation chart just
correct,
now.
Correct.
It has been trading at single-digit PE.
Yep.
Yeah. Please feel free to type your question in the chat box. Okay. All right. Okay. China's spending has been quite disappointing since reopening. What are the other positive factors in China that can boost, optimism within the investors?
So bad news is good news, right? Today, if the China spending is very at the peak, then probably the government will say, hey, slow down, yeah?
Yeah.
So, we don't want to repeat the mistake like what US is, has experienced, right? Because of uncontrolled or not managing well, the inflation goes sky high. And in terms of, because it's a result of printing a lot of money to boost the economy during the pandemic time, right? So luckily to say that China didn't do that as much, right? Although they support, but they did not print that much of money. Therefore, now when we see that the spending, like just now, the Labor Day, the spending per capita is actually under expected. It's still not as good as what people expect. That will actually trigger a lot of stimulus coming. Equity market likes stimulus, right?
Yeah.
So that means when governments see, hey, the spending is not as good and the data is actually disappointing, what's next? The government will actually say, okay, we stimulate, we put in some measure, and that will actually boost the recovery going forward. And equity market likes that. Yeah.
Hopefully, there are more and more supportive, policies that can actually drive the markets moving forward.
Yeah. In fact, the officer actually came out and said that there will be more and more. Yeah. Because domestic consumption is very important, and remember the dual circulation thing is still in the card. Yeah. So they will continue to do that.
We have a questions on Malaysia REITs. Any thoughts on the REITs?
REITs, okay. When you play REITs, when you can get return higher than rather putting in your money in a bank, right?
Yeah.
Okay. And if let's say you want REITs, right, now it's already at a peak.
Yeah.
Probably we expect going forward there will be only one way down.
Yeah.
You could position some in your REIT, but make sure that you know which REITs that you want to go in. Retail REITs is good, right? But don't put your money in a commercial building, commercial REIT in the US. I will have to remind this: the commercial real estate in US could be another bomb, because of the very low occupancy rate. All that, Warren Buffett has said that during his AGM. So I think it has to be very selective. The industrial rate in Singapore and Malaysia will be another good play. I think yes. Generally, if you expect the rate is coming off, you should play. But we are not very bullish at this moment because we think that the interest rate will not come down as fast or as big. So don't forget, in Malaysia, the OPR pre-COVID, right, is 3.25. So even we have another hike this year, and now it's about 3, and then another hike is 3.25. We are just back to pre-COVID level. So how much more that do you expect rate to come off? The rate to come off. So that is our view.
All right. Okay. I think we have addressed all the questions in the chat box. Thank you so much, Ch'ng Siew, for sharing her thoughts with all the participants today. And thank you so much to all participants for joining our session today. Stay tuned for our upcoming Phillip Mastermind. Thank you.
Thank you.
Bye.
Bye-bye.